Ding ding. Yeah, day's over. Closed at 50.22. This is definitely below the CTA trigger. A close here is probably going to have some relevance. I mean, it's not as big a deal as a close below 5,000 would have been, but it's still a significant decline and puts us that much closer to delta neutral and those JPM long puts. It's also going to drive more of a CTA sell off into tomorrow. This is pretty bad, right? This is the start of the breakdown of that bearish like continuation that we had, right? This whole thing, and yeah, this is where it's starting to break down, right? We had a little brief recovery that failed, so I'd be targeting lower for the rest of the move. That could happen even overnight. Commodities down about 80 points today. Dollar slipping finally back below 106. And yields driving down a little bit as well. A lot of this on the back of the euro rising and unexpectedly hot inflation print that came in this morning. Correlation on the 1 month is still kind of turning around. They're still trying to lever that dispersion trade, but correlation on the 3 month is turning back up again after pulling back yesterday. We've got a little bit of deleveraging in the carry trade. Most of this occurred today. Yield on volatility 5.33% with the yield on the 210 at 8.11. So that's getting pretty tight. Forward yield on volatility remains positive. That's going to continue to drive demand for vol. Move, I'm not sure if that's printed yet for today. Skew dropped 135.6. That might be yesterday too. Yeah, 9% of the or yeah, 9% of the S&P under its 20-day, or 9% of the S&P over its 20-day moving average. We got a little bit of a decline or increase in correlation between spot VIX and cash, although it's staying very tight. It hasn't really picked up a lot of positive correlation yet. 0.36 rate cuts priced in, or 36 and a half points of rate cuts priced in for the rest of 2024. A little bit earlier today, I think that hit like 33. It's pretty much staying flat. There was a little bit of movement on it yesterday during Powell's speech, but not much until the Fed definitively cuts that last rate hike from this year. We're gonna price it in to some degree, and that's what we're seeing here. So we're not pricing in two anymore, but we are still pricing in one. Oil took a massive hit today, down 300 basis points, and this is a lot of this on the easing of geopolitical tension in Israel, Iran, as it looks more and more like Israel's planning a strike, but they may not commit to it, or if they do, they're planning a small one. It's hard to say how that's going to shake out. Obviously, they could strike back, that could escalate things, and we'll see risk premium be priced right back in. But for now, it seems the tensions are cooling a bit, and I think that's about it for today. I know some of the ECB speakers were talking about they're not entirely sure if they're going to move forward with a rate cut, and so some of the risk of central banks diverting is slightly diminished today, especially after the ECB speakers. If they think that the ECB is going to cut around the same time as the Fed, we're going to price in a little less currency risk. When KRE puts? Not yet. Also, I think the House is voting on Ukraine, Israel, and Taiwan bills either today or tomorrow, and then also a Chinese Russian sanction bill that includes the possible banning of TikTok. All right. For tomorrow, we have jobless claims first thing in the morning. That's going to be moderately important. I mean, we haven't had any labor data for a couple weeks, and so a peek at the labor conditions might offer something up. I doubt it'll have a big effect. I mean, we looked at the beige book today, and it seems like across all of the Fed districts, labor is still quite strong. So I don't think we're going to see any weakening in labor. Obviously, that's bearish. It's positive for the dollar. Wages might be declining, but we're not going to get that report for another couple of weeks. And then we have Philly Fed, which probably won't be very important. And then lastly, tomorrow, I think probably the most important thing tomorrow is going to be existing home sales. They're projected to fall. They may not. If housing demand is still up, that means housing inflation is probably going to stay elevated because prices aren't going to decline. At 1 o'clock tomorrow, we have a 5-year TIPS auction, and that'll give us some insight into the bond market's 5-year expectation for inflation, which, previously was around 1.7%. We may see that rise substantially. So, dude, curious if you could shed some light on this for me. How can a company like Express have 65 million cash on hand and only a 2.9 million market cap? What am I missing? It's got a lot of risk priced in. Also, their cash on hand, I mean, is okay, but look at their debt. Debt is definitely the thing that's scaring investors away there and causing that, shitty PE ratio. All right, thank you guys so much. I will see you bright and early tomorrow. Have a great night. Later.